The Interest Rate Profile tool is the one-stop shop for Hedgebook's interest rate analytics, and this video is going to take a walk through the various tables and charts presented within it. The Interest Rate Profile tool is accessed from the main page of the Hedgebook app. The first step is to select a debt forecast scenario that you have previously created or create a new one. I'll choose a demo one I have previously created. The tool has been developed to help finance teams present key interest rate data in a visually compelling way. Often the information will be used for treasury management reporting purposes. On launching the Interest Rate Profile tool, Hedgebook collates and aggregates all the necessary interest rate data from within the portfolio to drive the various charts and tables. A lot of data is summarized in the top two charts, so let's break it down. First of all, we need to supply debt forecasts. In Hedgebook, we can capture both core debt and forecast debt. Core debt is likely to be less volatile than forecast debt, as core debt will look through the ups and downs of working capital and seasonal patterns. In our experience, companies will often use core debt to drive interest rate hedging decisions, but also require forecast debt to understand interest cost outcomes. The debt numbers can easily be pasted from a spreadsheet, and they are then presented in the chart. We then overlay the chart with any hedging or fixed rate debt. Interest rate swaps, options, or fixed rate debt such as bonds all contribute to the fixed rate notional. The detail of the various instruments is shown within these individual tables and aggregated into the chart indicated by the green section. You can see the reducing notional which lines up with the maturity of the various fixed rate instruments. Also included, if applicable, are the interest rate risk control limits, i.e. the minimum and maximum fixed rate hedging as set out in the company's treasury policy. These limits provide a risk framework to operate within, ensuring the company has a certain amount of fixed rate hedging as protection against higher interest rates, as well as reducing the volatility of interest costs. In my example, I have a policy that allows hedging out to 10 years, split into 3 time periods or buckets. The risk control limits allow for a higher percentage of hedging in the nearer years due to the greater certainty of the debt forecast. You can use the toggle to base the hedging calculations on either core debt or forecast debt. Often core debt is used for policy compliance purposes. In my example, I can see I have a small period of non-compliance in mid-2028, but otherwise my green shaded area sits between the lower and upper policy limits, i.e. the dotted and solid red lines. By combining the fixed rate hedging with the unhedged debt at prevailing floating rates, we can calculate an indicative interest rate and interest cost across time horizons. This table provides indicative annual interest rates and costs based on debt forecasts, hedging, fixed rate products such as bonds, and the future floating rates as determined by the prevailing interest rate market. These numbers are useful for long-term planning and budgeting. You can select either core debt or forecast debt to drive the numbers. A debt funding margin can also be included. The green line in the chart shows the weighted average interest rate, including the margin. The right-hand chart has 3 lines. The grey line is the weighted average fixed rate based on derivatives, such as interest rate swaps and options, plus any fixed rate debt products, such as fixed rate bonds. The yellow line is the implied floating rate, based on the prevailing interest rate market. The green line is the appropriate combination of the first 2 lines based on the selected debt forecast, plus any assumption around funding margin. You can use the Interest Rate Profile tool for scenario analysis and trying out trade ideas. You can add a hypothetical interest rate swap, such as I am doing here with a new $5 million swap. In doing so, I have resolved my policy compliance issue. I can also flex the market floating rates and see the impact on my interest rate and costs. For example, a 50 basis point shift upwards increases my interest costs for the portion of unhedged debt. You can also see what the hedge position is against policy at future periods. This could be the next key reporting date, such as financial year end. You can add any notes to this comment section for future reference. And if you have made any changes to the tool, such as added a trade idea or updated your debt forecasts, then make sure to save forecast before closing the web page, otherwise your changes will be lost. We also have analytics around funding and facilities, i.e. liquidity management. There is a separate video on this. Many corporates use interest rate derivatives to manage their interest rate risk, particularly to protect against a higher interest rate environment and provide some interest cost certainty. Managing these derivatives is more easily achieved with systems that provide the appropriate controls and compliance. If you have any questions or would like to know more about Hedgebook's functionality, we would love to hear from you. Cheers!